Okay, welcome everyone. Thank you for joining us today for this webinar, Interest Rate and FX Risk, How to Avoid Inflating Your Risk. To introduce myself, I am Muad Al-Husseini from Ihata Financial. I'll do the introduction and then I'm going to pass it over to Benoit from GCRA to talk about how hedging is best utilized to manage financial risks. Then he will hand it back to me to briefly talk about the recent local trends surrounding hedging through complex derivative transactions. And then back again to GCRA, where Benoit would tackle issues around restructuring the hedging portfolio and how such sensitive process should be approached and managed. Last thing in this section, Faisal Al-Jasser from Ihata Financial will talk about the cornerstone of any market risk management practice, that is the hedging policy, and its importance for every entity that is exposed to market risk. Last but not least, we will conclude by walking through an emerging topic locally regarding the accounting treatment of hedging instrument, that is hedge accounting. And our colleague from GCRA, Paco, will shed some light on the subject. As an introduction, Ihata Financial is an independent financial risk advisory firm regulated by the Capital Market Authority in Saudi and mainly focused on financial derivatives and hedging, including policy setting, structuring, pricing, valuations, and hedge execution assistance. During last year alone, Ihata have advised on more than 15 billion Riyal value of transactions across more than 5 different sectors within the kingdom. Our associate on the call, JCRA, have been in the business of providing financial risk management advice for more than 30 years and recently became part of Chatham Financial. They collectively serve more than 3,000 clients across more than 20,000 transactions every year. One thing to highlight is that both Ihata and GCRA are not product sellers or brokers, so our advice is fully independent and not tied to any particular outcome or product sold. This webinar is being recorded. We aim to wrap up the presentation within the 45 minutes, including the Q&A session. We will make sure to share the recording with you post the webinar. During or after the presentation, you may type any question in the question box on your screen. Your question will not be visible to any members of the audience. We will also ask 2 questions during the webinar, which you can easily respond to by clicking the most relevant answer from the multiple choices presented to you. Okay, I will pass the mic now to Benoit from GCRA to walk us through a couple of slides around hedging as a financial risk management tool. Over to you, Benoit.
Thank you everyone on the call. It's a pleasure to be with you this morning. If we jump to the next slide, and before we discuss in a bit more detail why it's important to hedge, I'm going to give you a brief overview of the traditional risk we see for our clients. So many FX risk and interest rate risk. On the FX risk, they are usually well known, but it's worth just stating them again. So usually you have 3 common FX risk. One is called translation, the other one is called transaction, and the last one is called economic or sometimes strategic. If we think about translation, it's just you have foreign item on your balance sheet, and when you are going to reconvert them, it's going to create some FX volatility. If we think about transaction, it's more about cash flow. You have future cash flow denominated in different currencies. It could be revenue, it could be cost, how you want to hedge those cash flow from FX risk. And the last one is very interesting, is economic or strategic, which is basically the risk in the market you operate. So if you think about Boeing versus Airbus, they both operate in a market that is where you sell in dollar, but their cost structure is very different and with regards to FX. What is important about those 3 risks in the FX world is the first 2, you can usually hedge them with derivatives and sometimes with debt. So that's a possibility not involving the derivatives. The third one is usually very difficult to hedge with derivatives because at some point you need to think about the business plan and what do you want to do if you have a major FX dislocation. On the interest rate risk, it's usually, very easy to understand where is your exposure. You are going to finance yourself either at fixed rate or floating rate. And then it becomes a discussion, what is my float fixed ratio? Do I have a policy? Do I want to rebalance? I've issued too much fixed debt. Should I enter into swaps to get a better ratio, or I'm just going to get bank financing at floating rate and I want to hedge my interest rate exposure? So those are really the risk we are looking at. If we jump to the next slide, which is very, I would say, why it's important to hedge and what do you want to manage those risks? Why do you want to use ultimately derivatives to mitigate those risks? So we have listed some of the common benefits also. So reducing cash flow and earning volatility is something you may want to do, also because it has an impact of valuation. It gives you visibility. It's good practice. On the interest rate, if you manage the cost of your financing, it's usually also something that gives you visibility. And if you operate in a business with tight margin, it's something you want to have control. The third point, you can argue that to a certain point, if you manage your cost of financing, you can manage your overall cost of capital, and it can increase profit and valuation of the company. If you just think about a straightforward discounted cash flow analysis for your company, the lower your cost of capital, the higher the value of the company. Ultimately, if you are listed and you pay, for example, dividends to your shareholder, you want to make sure also you can maximize those payments. If you are private, it's going to be the same thing. And you show good practice by also controlling your operating cost by, for example, removing FX fluctuation. At the bottom, we explain why ultimately that could be or create some issue if you don't really manage to mitigate or remove some of the risk. If you start to have lower profitability and market value potentially because of financial risk volatility, you might not be able to develop or expand or make those investments for your business to bring additional value. And ultimately, some of those metrics we discussed, for example, like EBITDA, debt, you may have covenant risk that could create potential issue down the line if you don't think carefully about those. So those are the points we wanted to mention. I will now hand over to Muad for the next part.
Thank you very much, Benoit. I guess before proceeding to the next topic, we are having some poll question that we ask you to kindly answer, and I think the question is in front of you now. It says that, have you considered hedging your FX or interest rate risk? You can select one of the answers. Yes, and we are actively hedging our exposure. Yes, but we have not engaged in any hedging activities yet. No, as we do not have exposures to both risk, or no, as we can absorb the P&L impact. I'll give you 10 to 20 seconds to answer this poll. Thank you very much. Thank you very much. So to show the answers, okay, wow, it seems that in the audience, 0% has answered no, as we do not have exposure to both risk, which means that the audience members have indeed exposures with varying percentages here and there. Benoit, what are your view on the answers in front of you?
I would say it's probably as expected, or we are not really surprised by the split, and we see similar things within our client. What is interesting about the last one is usually it's up to a certain point, because at some point too much P&L volatility is going to be an issue, especially if you are listed. But I think the answers would be similar if we would run a similar survey in Europe.
Excellent. Thank you very much. I guess now we will move to the next slide, tackling the local trend of complex hedging transactions. I will take this part, and I believe that this is a critical topic in the webinar. When considering hedging your portfolio, we always prefer to look at plain vanilla instruments as a mean to hedge, given its basic and understandable structure or form, and most importantly, serving the hedging objective. The reason we made sure to bring this subject up is because of what we observed locally during the last few years. We witnessed that few firms or entities were engaging into complex FX and interest rate derivative transactions, mainly with banks, without a clear idea of the potential implications of carrying such risk. Some firms were utilizing the use of derivatives with the aim of achieving short-term gains and supporting the operational and financial hurdles. And some others were focused on actually hedging its exposure, but the misunderstanding of the embedded risk has caused them a great deal of financial difficulties due to misalignment between the hedging needs and the implemented strategy. In fact, this reminds me of few transactions that we worked on locally, helping clients where appropriate and applicable to assist in compensating for the damage caused by derivative mis-selling, as well as help in restructuring the hedge portfolio. Hence, and again, the issue starts when firms divert from a hedging objective of protecting their core business to the speculative space, which utilizes leverage, long-dated exposures with open-ended risk, and sometimes, well, most of the times, limited upside. And most notably is the mismatch between the hedging instrument and the item the firm would like to hedge, be it loan, be it FX, or any commodity exposure. So depending on the eventuality and the magnitude of the outcome, some firms with such practice might run into severe financial difficulty, reputational damage, and potentially bankrupt. I guess some of you have heard or came across few examples of such derivative misuse locally and internationally. And one of the examples I can mention here, if you allow me, is for a company based in UK called Best at Travel, which has been in the business for more than 30 years now. As part of their daily business, they buy and sell foreign currencies that are generated from their sales. The business struggled to deal with a hedge that they executed a few years back with the banks. This hedge was considered by analysts as a mis-selling scandal. The FX contracts themselves entered into is called Target Redemption Forward, TARF, which basically offers to buy and sell foreign currencies at better than the prevailing market rate. But as they say, there is no free lunch. High volatility and unfavorable FX movement can lead to significant risk, such as trading at much worse than the market rate with leveraged exposure. Sadly, these contracts led to millions of pounds of losses, as per the Financial Times article I read last week. The story continues to talk about the case going to court for a claim against the 5 banks that sold the trades. This was an international case, but honestly, we have seen local derivatives misuse that ruin or potentially would ruin the financial stability of those who are considering engaging into complex trades. Maybe these local examples are more toward interest rate related instruments, which are referred to as cheapeners or cost reduction ideas. The complexity of these trades makes it difficult for the users to estimate the true carried risk and also make the visibility of the pricing vague. The problem gets more complicated when restructuring an exotic hedge portfolio and carry on the discussion around how can we optimally restructure an exotic portfolio with such vague pricing. Hence, having a proper and sound risk management culture along with governance framework is crucial. We will speak about this critical matter later in this webinar, but for now, I will pass it to Benoit to walk us through some considerations on restructuring the hedge portfolio.
Thank you, Muad. Restructuring is an interesting topic because if you think about derivatives, complex or not, and usually we tend to recommend our client to look for simple solution, just to not change too much the risk-reward profile of a derivatives. It would be very nice ultimately to enter into a derivatives, park it somewhere, go on holiday, and just you leave it there. You have nothing to do. But in reality, when you use derivatives for hedging, it's a great way to mitigate financial risk, but you will have to monitor them carefully. Just because your underlying exposure, because you are doing hedging, you have an exposure that you want to hedge, is going to change. It could be you are expecting a certain cash flow in the future, and the size of this cash flow will be different. The timing of this cash flow is going to be different. It could be you are hedging your interest rate debt, and your debt is going to be repaid. What do you need to do with your existing hedging? It could be a change in business plan. You are not going to expand your business overseas, and before that you enter into some derivatives to cover that particular part. It could be an area of your business that is non-performing. It could be, for example, the P&L volatility that the instrument is going to create in your balance sheet, in your results. So all those things means that at some point you will have to look at maybe restructuring. And by restructuring, we'll see after that we looked at several options. So what is really, really key when you think about restructuring is not to rush the decision, but really to think about all the consideration you need before making the decision on what you want to do. So you need to check, for example, your existing policy or existing documentation. It's very important to have a clear understanding of the impact of the restructuring on your main KPI, or if you have a particular set of objectives. As Paco will discuss also, hedge accounting is usually key. So those discussions need to happen before you start changing your hedging parameters or your instrument. Ultimately, when you know what you want to do, you will have to think about what is the best way to execute this restructuring. You may have several banks involved. You may have banks that are both lender, both offering derivatives. Some may stay in a new financing, some may not stay in new financing. So you need to think about those things. And you also need to factor about the hedging needs in the future for the company. In the current slide, you can see this is where I would say restructuring is not limited to one single item, but is actually quite wide. And the way you can think about it, the most obvious one would be, I'm going to terminate my hedging instrument. So then you have a set of questions you need to ask yourself. What is the value of these derivatives? Maybe you start with a mid mark-to-market value, so what the bank is going to provide me on a mid basis. But then if I want to terminate that transaction, the bank is going to charge me to cancel some of the market risk the bank has. So what are those costs or those execution costs? And then you have a lot of actually adjustments called XVA, where there are a lot of debate if you can manage to get some sometimes benefits or rebates paid to you when you terminate those trades, and the policy is going to be very different bank to bank. So all those three items will drive how much you will get paid or have to pay to terminate the transaction. So termination is one bucket of restructuring. The other one is restructuring, which is restructuring per se, which is, I would say, easier to understand. So instead of terminating my trades, I'm going to modify the characteristic of my existing contract, make it longer, make the notional different, and don't have any payment to make when I restructure the contract at that point in time. So you have a lot of questions that are going to come to the table when you want to do that. How much is my current derivatives at, what is the current value of that derivatives? Now, if I extend it, do I need credit limit? All those value adjustments we discussed, they are going also to be impacted. All those things need to be factored in the decision for restructuring. And the last one is called novation. So I don't know if everyone is familiar with novation, but novation is a situation where you as a client, you face bank A, and you have a third counterparty called bank B. You have an existing trade between you and bank A, and ultimately after renovation, you are going to face bank B. So bank A is going to disappear, move the derivatives from U to U and bank B. And associated to that, as you can imagine, there are a certain number of costs, also driven by some valuation adjustment, some particular policy from the banks. So all those things need to be carefully managed. And last thing, those three elements, so termination, restructuring, innovation, they don't work always in isolation. So you can have, it's possible to combine them. You can do innovation to another bank and then restructure or terminate the bank with this trade with a new bank. You can do, for example, restructuring a trade with a bank because they are particularly good at those type of derivatives, and then innovate to a different set of banks. So you need to be open about restructuring. It could mean a lot of different things, and you can combine all those different elements. But as you can imagine, if you start to think about all the combination you have between 1, 2, and 3, this is where you need to spend a bit of more time. Then to conclude my part on how we looked at, for example, interest rate risk management for clients, and this is the slide you have. We usually have like 3 different phases. So the first one is really like a pure analysis phases where you think about all the key considerations for your hedging strategy. What are your objectives? Is there any hedging strategy letters that you need to fulfill? And then everything about the process. So what are your KPI impact in different market risk scenario, regulation impact, if you need to enter into an ISDA to do your trade, accounting as we discussed, some credit consideration, documentation. Then we move to a second phase, which is really execution. And here the idea is just to get a very transparent, auditable price for you and make sure you get a very good price for any instrument. It could be new hedge, it could be restructuring. So we help the client to manage those processes, and we have done process where we have run auction with clients with like 8 or 10 banks on different calls. So that could be quite difficult to do. But we are going to benchmark and negotiate mid-market values, execution spread, all these XVS or so-called valuation adjustment, and ultimately help you to enter into the transaction. When the transaction is done, what is really critical is also like the post-deal reporting, just to make sure you have all the recordings, all the executed documentation, and then you can move to something which is during the life of the trade. What is the accounting treatment of that particular derivatives? Do you need to do quarterly, annual accounting? Do you need to take into valuation with BCVA and things like that? So those are usually the 3 steps we see for interest rate mandate, and it's the same for FX, it's the same usually for every single asset classes. So I'm going to hand over to Faisal now.
Thank you, Benoit, and greetings, everyone. Okay, so here I will be talking about the governance of the hedging process and the importance of a hedging policy. At first, I would like to highlight 2 major advantages of having a hedging policy, or I guess we can also call it a market risk management policy. The first, a policy establishes objectives, standards, authorized hedging instruments, reporting requirements, and responsibilities for the prudent use of hedging instruments. The second advantage, it enables the identification and evaluation of risks, the process of setting acceptable risk thresholds and identifying and mapping controls against these risks. So we believe by adopting and successfully implementing such a policy, the end result for an entity would then come to be a process that allocates clear responsibilities and allows for an auditable and repeatable approach to all potential hedging decisions at that entity. So before we go through the key elements of a typical hedging policy, I would like to share with you the results of a recently conducted survey by Bloomberg for more than 100 corporate treasuries on the use of some statistical risk management measures such as value at risk or cash flow at risk as part of their efforts to minimize foreign exchange losses and to do a better job of linking them to company KPIs. The results have shown that 34% of respondents already use such risk measures, while 29% on the other hand are considering using them, and only 8% have never heard of them. The survey also revealed that 64% of respondents are considering improving their company current hedging policy. However, when it comes to the obstacles of adopting such a risk quantitative-based hedging policy, difficulties of explaining such a policy internally and to the board was one obstacle that respondents have reported. Second, reluctancy to change the entity technology. Third, being afraid that it would be too complex or costly. And finally, being unsure of the envisaged benefit of such an exercise where all the major obstacles reported in the survey. With 66% of respondents stated that their main concern was the first one, which is explaining such a policy internally. So from this, we would sense that there is a desire to improve the risk quantification function within these surveyed corporate treasuries, which naturally will come with its own challenges. But we believe the long-term benefit of such an exercise is definitely worth the effort. In terms of scope, a market risk policy is basically the function of the asset classes it covers. For example, does it cover only interest rate or just equity, FX, maybe commodity? So the more asset classes the entity is exposed to, the lengthier is the policy. It is also a function of the organizational structure, meaning will it apply only at holding level or will it also cover any affiliates under the group? So to give you a brief on the major key elements we tend to include in such policies when advising our clients, I would start with approvals and communications, and I'm referring here to the policy itself. And that can either be annually or less than that, depending on the entity's operational complexity and the attributes of the exposure. Then more importantly, the risk management objectives when it comes to the risk factors the entity is exposed to and the identification of specific KPIs that the entity aims to protect, and that could also include lender covenants. Then we have exposure identification and measurement. This part is also very important. And it differs from one asset class to another. This exercise will also allow the entity to understand the magnitude and materiality of risk and to identify the potential impact of these risk factor volatility on financial performance. Here, the possibility of natural hedging, i.e. matching assets and liabilities together and avoiding off-balance sheet hedging can be identified. Also, the establishment of risk limits and triggers. Then comes the management of these risks and the determination of the hedging strategy. As this exercise will typically entail documenting the outcome of the KPIs test before executing or deciding on any additional hedges. This exercise will also include any risk-reward analysis and essentially the viability of hedging in the first place, given its cost, i.e. is there an economic value addition when hedging? A policy will also govern the timing for hedging, for hedge implementation and the execution protocol, which would assist the entity to avoid the possibility of unagreed margins or maybe slippage caused due to lack of liquidity, and overall the handling of unfavorable market movements and hedge counterparty management. Also, as you would understand, guidelines and controls, roles and responsibilities, and the reporting requirements are all an integral part in a hedging policy. And last but not least, a policy would identify permissible products and even the workflow process should a non-permissible product were to be chosen by the entity. So I hope that I was able to summarize the main idea behind the hedging policy and also been able to give you a glimpse on its potential long-term positive effect to any given entity that faces market risk as part of its operations. I leave it now for my colleague Baku to give you a brief on hedge accounting. Thank you.
Thank you, Faisal. I believe we have now a question as well for the audience about hedge accounting. If the attendants, please, can take just a few seconds to respond to the following question. Do you currently apply hedge accounting? So you may be doing it in-house. You may be aware you need to improve your process. Maybe you don't need to apply hedge accounting because you can be exposed to the P&L volatility. Maybe you think you could benefit from knowing more about it, or just simply you don't need it because you don't enter into hedges right now. If you can please submit your question, your answer, we will be able to share the results in just a few seconds. Right, so maybe we can look at the results. Okay, so most of them, similar percentages to the question on hedging. No, we don't apply it, but we could benefit from knowing more about it. Or no, we don't use hedging instruments. So certainly the last one is probably the easy one. And then there's a small fraction of people that says, yes, we could improve our process. Okay, that's interesting. That probably speaks to us as most of the respondents probably are currently not applying hedge accounting, or they don't, basically they don't know enough about it, or they could benefit from knowing more, or they just simply don't have hedging instruments. So let's try to spend just a few minutes into what are the basics of hedge accounting and why hedge accounting is important. So if we can look maybe at the first slide, this is just a brief overview of basically how to account for hedging instruments, derivatives, under IFRS, under International Accounting Standards. In fact, it's not only under IFRS that these principles apply, but we would say that it's basically any international or any national accounting standard that is based around the concept of fair value recognition. Because in most of the accounting standards around the world nowadays, the derivatives have to be recorded on the balance sheet of the reporting entities. They have to be presented as assets or liabilities at their fair value, basically what we call the mark-to-market of the hedges. And as well, usually there's a need to include as well credit risk adjustment into that valuation. That's what is called the CVA or the DVA adjustment. The changes in fair value of the derivatives are usually being recorded straight into earnings for the year in which those changes occur. It's basically a P&L from financial instruments. We usually don't see that as being part of interest expense if interest rate hedging is in place, or EBITDA if FX or commodity hedging is being entered into. Now, the issue with that accounting is that recording the changes in fair value into earnings is going to produce volatility, unfortunately, volatility arising from hedging activities. In several instances, that volatility can be avoided. And for instance, when hedging with interest rate swaps or caps, if the company elects to apply cash flow hedge accounting, the changes in fair value of the derivative will not be recorded into earnings, but will be recorded into OCI or the comprehensive income. It's a cash flow hedge reserve. It's a non-distributable reserve within the equity of the reporting entities. And later on, that fair value change will be reclassified to the interest expense when the interest on the loan is accrued, for instance. Be mindful as well that under accounting standards, there are some specificities for accounting for options, for instance, caps or plain vanilla options on FX. And it's usually just only the changes in intrinsic value, not the changes in the time value, that can gain this more favorable accounting treatment of cash flow hedge accounting or hedge accounting instruments. So therefore, for options, all entities that enter into options, they will have to be able to split time value from intrinsic value if they want to reduce P&L volatility. All this seems a bit complex, but the underlying message is that unfortunately, hedging via derivatives, via swaps, caps, forwards, may cause balance sheet, P&L, and equity volatility. As an election, though, entities, companies may reduce that P&L volatility by applying hedge accounting. Usually, right, that hedge accounting will be applied either in-house or with some guidance from the auditors or with external companies, like for instance, JCRA and IHATA, in which they almost kind of outsource all the heavy lifting of hedge accounting to their clients. Because hedge accounting basically means some extra work for entity teams to satisfy accounting requirements. There will have to be periodic valuations, monthly valuations, quarterly valuations, annual evaluations with credit risk or without it. There will have to be documentation being put in place and approved by stakeholders. There'll have to be as well qualitative or quantitative effectiveness calculations, and as well, usually as well, some quantitative disclosures, like for instance, if the market moves up and down by 0.25 basis points, what's the change in fair value of the derivative? Or a disclosure of what are the future cash flows of the derivatives of the next 1 year, 3 years, 5 years, or more. The next slide is a quick summary recap of basically what should be the drivers of applying hedge accounting to a derivative contract or not. So if a derivative contract is designated as a hedge, basically, what is the company going to win? So what is it going to gain? So if it is not designated, we're saying the recorded fair value of the mark-to-market and the changes are recorded through P&L. And unfortunately, that means that the effects or the impact of the derivative is not going to match the timing of the hedged item cash flow. And we usually don't see those derivatives being accounted as interest expense, those changes in fair value, because basically you don't want to contaminate that KPI. But on the other hand, if it is opted into the designation realm, then that basically means that the derivative is going to match in timing the hedge cash flow impact in P&L, and usually by applying hedge accounting, the interest expense or the KPI that is being hedged will be showing the impacts of the hedge. Eventually, the decision drivers of whether to apply hedge accounting or not are basically a thorough analysis of the KPI. Is interest expense something that needs to reflect the hedge, or is just simply net cash flow that we're considering? In the former, hedge accounting should certainly be analyzed and considered. But if it is only just net cash flow, it's not necessary. You can probably leave out with the P&L volatility. But in any case, there's always a lot of influence and as well opinion of external auditors, which eventually have to provide some guidance on how to apply, if it is possible, hedge accounting in order to minimize P&L volatility. And I believe we have reached the end of the webinar, and we're going to go now into a few minutes of Q&A. Faisal, Muad?
Thank you very much, Paco. I guess we have seen multiple questions across the different topics, Paco, but since you have just concluded your hedge accounting part, I would come back to you now in terms of questions. 2 questions on hedge accounting, Paco, for you. The first is, what are the biggest challenges when conducting a hedge accounting exercise? This is the first one. And the second one is, can hedge accounting be applied when the hedge is not 100% linked to a certain loan?
Right, so on the first question, what is the biggest challenge? Sometimes it's the exposure that is being hedged. The companies have to understand very well what is the P&L impact of the exposure. We've seen sometimes the companies wanted to apply hedge accounting to effects of the consolidation of foreign subsidiaries. That is usually not possible. That is just simply a translation impact that does not produce P&L. As well, another challenge is sometimes related to the instrument that the company wants to apply hedge accounting to. We've seen that some more exotic or leverage trades, knockout caps, knock-in caps, as well, knock-ins, knockouts, FX options. Sometimes the auditors, they basically categorize those instruments as net written option, and it's not possible to apply hedge accounting to that. Depending on the sector as well, we've seen a lot of challenges and difficulties in accounting for restructuring of hedges as well. In many cases, there are some P&L impacts there that have to be thoroughly analyzed before the transaction takes place. And the second question that you had, can you repeat that question, please?
It is. Can the hedge accounting be applied when the hedge itself is not linked to a certain loan 100%?
It certainly can be applied. I would say probably based in our experience, it really depends on the accounting standards of the jurisdiction. In some jurisdictions, there's a lot of emphasis on the underlying, the loan, and as well the derivative, maybe to match each term, or the exposure and the derivative to be a mirror of each other.
Yes.
In order to apply hedge accounting. Some other jurisdiction or standards, like for instance IFRS, doesn't really put emphasis on this matching of terms or characteristics. But certainly, if the underlying and the derivative are not matching each other 100% perfectly well, then some ineffectiveness, some P&L could arise. In the slide of accounting, there's a very, very important word called effective. So whichever entity wants to apply hedge accounting, they will always have to quantify or demonstrate that the hedge is effective, depending on the jurisdiction, up to a certain degree of effectiveness or any degree whatsoever. And that requires to quantify the change in fair value of the underlying and the change in fair value of the derivative. So that in itself as well is probably as well part of the first question as well put by the audience, right? It is not easy to perform some quantitative analysis or testing. Effectiveness calculations in effectiveness measurements require, usually by all accounting standards, if the entities do not have a valuation system or some kind of tool or someone external that can do this for them.
Well said, Paco. Thank you very much. There is a hedging policy question for you, Faisal. So the question says, can a hedging policy include risk other than the market risk?
Thank you, Muad. Yes, basically, yeah, we are mainly referring here to market risk, that's true. But a hedging policy can also include elements of other risks, such as credit, liquidity, and other as deemed relevant, I suppose. I would also add that counterparty credit risk for active and large entities is viewed to be an important element of the risk monitoring plan and can definitely be part of a hedging policy. We ourselves tend to include the credit quality of hedge counterparties in our hedging policies. Yet at the end of the day, it will depend on the entity risk management objectives, its exposure, and its operational complexity. So hope that answered the question.
Yes, indeed, Faisal, thank you very much. We can take a third question, and I'm very sorry I can't cover all the questions here, but there is a question says, I think this is to me, that there are local examples of mis-selling, but we have not heard of these publicly. Can you clarify? Okay, let me answer that in twofold. Number one is that privately held firms tend not to make public such losses related to derivative transactions, and hence reliable data is limited. But also, if you check the disclosures of some publicly listed firms, you will definitely find a few examples of large losses caused by misuse of financial derivative. Number two is that these instruments tend to normally have 4 to 6 years of duration. I'm talking locally, perhaps. And the risk or the true risk is loaded at the far end of the curve as opposed to the near term. For this reason, we might witness losses and cases clustering toward the second half of these instruments' duration, not at the start. I hope I answered that. Okay. I'm afraid that the time is up for the webinar. If you like to follow up on any question, or in case that there are unanswered questions, please do get in touch and we will be glad to get back to you. As I said, we will email you the recording of the webinar this week, and please feel free to share it or tag it. Finally, thanks to our panelists, and sincere thanks also to you for joining us. We look forward conducting similar webinars going forward. Thank you and goodbye.
Thank you.
Thank you. Goodbye.